This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
Hi, this is Joe. So what I'm going to do today, I want to talk about the 18 MA. All right. And I want to show first the 18 and the 40 together, and then show how we have some clarity when we start to focus in on the 18, which is the way I describe it in my book. All right. Let's go ahead and get going with this. So now, if you want to learn more about some of these techniques, I would suggest taking a look at the book. It is offered at a discount right now. You can go to rabilstockresearch.com/book for more information. Okay, so I'm going to start with Amazon with 4 time frames up. So just so you know, whenever I'm pulling up my 4 charts, I got a monthly here, got a weekly here, a daily in the upper right, and then an hourly in the upper left. All right. We're going to talk about all 4 of these time frames today. So if you notice, we've got the 18 and the 40 up right now. Okay, and it gives us a real good feel, especially when both lines are rising. 18 is above the 40 and both lines are rising. It gives us a confirmation of trend action. However, what I state in the book is that we want to focus in on the 18. So I actually would not have a problem if you took your 18 and changed it to a thick line. All right. Now, I don't do that anymore, but there was a time when I liked to have that and I had all 4 of these thicker, because I want you to think that the 18 is sort of the primary and the 40 is a supplemental tool. It's a buddy system where the 18 and the 40 are working together. Now, again, I have talked about this over and over again. I use an 18 simple moving average. If you want to use a 20 simple, it'll work fine. There's not a big difference between the two. But what I'll tell you is you want to use this 18 or 20 as a primary and then use the 40 to supplement that. All right. We want to use it to confirm. We want the 40 to be used as confirming evidence, but you're going to get your earlier signals and understand really what's taking place by looking at the 18. In most cases, the 18 will be a supplemental tool to also see the trend line. All right. So, really easy in most programs to flip that and change the thickness of that line. All right. Now, what I want you to do is I've got Amazon here with 4 time frames. I'm going to flip this over. Now, look at what we've got here. We've got the same chart and the same time frames, basically looking at everything, but we only have the 18 MA up right now. All right. Now, here's what I want to explain. So when I'm looking at let's say I'm starting with the monthly, and you notice how we get stretched away. This is something I was talking about on Fridays about the market, where we get too far away from the 18 MA on the big time frame on the monthly, but it stays up there for a while. Okay, once we see that, we want to start going down here, and we do want to look at the momentum and all that, but one of the things we're looking for is this line to be broken or violated, and we see a flattening of this line. You see what happened here? Let's zero in on this. So you get this situation where it was rising, stayed rising, stayed rising, stayed rising, and then flattened out with this bar coming down through. All right. Now, as that's taking place, as this is dropping down and then rallying back to that 18, which is rolling, that's this here dropping down and rallying up here. All right. This line, which was rising, was clearly broken and then rolled over. So when we're using this moving average this way, and we know we've got some room to get to the 18 on the monthly. That's 150. All right. And we break this at around 184. Okay. We know we have some room before we get to the next time frame. If we break this time, if we break the 18 week, we know the next target area is the 18 month. All right. And if we do that, then we can go to this time frame and look for the first time we get sort of a rally back to the 18 and then a reversal. Then we can use the 18 on the break of the 18 on this time frame. Now, you have to understand, and you want to be able to, I think in my course, I go through this a lot, but just talking about the ABC, the 40 will really help when it comes to the trigger. but we're looking for sort of an ABC retracement, and then the rebreak of the 18 is oftentimes a new signal to the downside. So just using this one simple moving average would have been incredibly helpful. Now let's take a quick look at Apple in the same regard. Now here's the difference. This is the monthly chart of Apple breaking out. Nice move. Yeah, it's a little bit stretched here, but here's where it starts to look like the Amazon monthly, right? It gets stretched away and it stays away for an extended period. We know we have some room for this to come in and correct. All right. Now, we don't do anything until we get a break on this time frame, and then you notice the rally back where it's rolled over and rallied back. And then again, if we have our opposing trend pattern, we would be looking for a reversal taking place on this time frame. So I'm using 3 time frames. At first on Amazon, it was really this time frame, and this time frame, and then maybe this to help with the trigger. But in this situation, this is just kind of giving us a framework that, yeah, there's a lot of support at 200. This is the one that's showing that it's really extended. This is the one where, and if you notice, what happens quite often is, and I can actually accelerate this up if I want, the break of the 18 is essentially the 1 in a 1, 2, 3, right? And then this is the 2. As I've said, I'm oftentimes looking at the 2. If I can confirm it on this time frame and I have room to this low, I can play this as a reversion trade, as a short play, or something like that. So if you want to do that, that is an option. But more important is understanding how to read the market using this one simple time frame. Once we get too far away on this time frame, we look for a sign that the next time frame is starting to roll, and then we can go down to the smaller time frame to help with entry if we want to play that, or we can just exit if we're long. Or you're probably using some type of a trailing stop approach. But knowing how to read the market, if you go through and look at Amazon and Apple and Google and a lot of these big names and seeing this all happen at once, or we can do it with the S&P, obviously. So we can just take a quick peek at the S&P now, and you can see that we got really stretched away here. Talked about this on Fridays for about 2 or 3 weeks. And then we even got sort of stretched away on this time frame. Then we had sort of an outside reversal bar, which caused the break of the 18 here. But then we got our rally back to the declining line. And then here's our ABC rally up and then coming back down through the 18 on this time frame. Now, what am I describing when I'm talking about this? On all these different charts, what am I looking at? I'm looking at Confluence. We're looking for Confluence. This means we've got room to get to this line. We've got room to get to this line. In fact, we could be breaking this line, probably will be breaking this line and heading back towards the monthly line, based on the fact that the futures are down pretty significantly. I'm doing this before the market opened yesterday. So anyway, the point I'm making is we want to see where we have Confluence, where we break the 18 and it's flattening out. If you have that, you have an opportunity. So this would have been a trade here for a move down to the 18 week. You see that? Now it's going to continue to the downside, but that's still a really good trade if you're understanding how to use this confluence of different time frames. So the bigger time frames are actually used as target areas, and the lower time frames are helping with trend and entry. All right, so use this to your advantage. I think this can be a great tool. And it can help across all different time frames. You can do this in short term. And then once you understand this primary moving average approach, then you want to start adding in your indicators. All right. Don't look at the indicators first. Use this as your primary tool and then use the indicators as supplemental tools. All right. Let me know if you have any questions. Thanks.